All right, as promised, we are going to go over the second half of Chapter 17 for commercial banking, and then on the next clip, we'll do Chapter 18. So we are at a point where we are analyzing the financial statements. We're a loan officer, or in this case, a credit. We're going to do some credit analysis. The credit analyst position is a very common entry-level job for a finance major coming out of college because it does not require a lot of client contact, but it does require some familiarity with the financial statements and understanding finance. And so typically this job involves working for a number of commercial lenders, commercial loan officers, and you as the analyst make sure that the loan files are complete, and then you run the numbers for the commercial lender to help them determine if the borrower has the capacity to repay a loan, and then it also helps them determine how to price the loan. All right, so the next few slides look at a bunch of financial data, ratios, financial statement items that come straight out of accounting, come straight out of finance, BanFin. All right, let's see if we can get this thing going. Come on. It's not working. Why isn't it working? All right, looks like I'm going to have to do it by hand. That's all right, I'll do it by hand. All right. Let's see, I don't know, you can't even see me. You may be able to hear. Oh, there you are, I can see. Okay, so information from the financial statements, typically supplemented by financial statement ratio analysis. And so these are the areas that are commonly looked at. I hate the way this is done. Let me see if I can get this thing going. Why isn't this thing going? Y'all bear with me for just a second. I may have to stick this into the computer directly. Let's see if we can get this thing. There we go. Let's see if it works. You gonna work? No, it's not. For some reason, it is not going to work. All right. So the different areas, don't you do that. There you go. So the different areas that financial analysts are going to look at, they're going to look at the level of expenses that a company runs. They'll look at operating efficiency at a company. And operating efficiency, one way to look at operating efficiency is asset turnover. How much money is invested in assets and how many dollars in sales is the company able to generate. So the goal is to generate a lot of sales with not too much money invested in assets. That's the goal of every business. All right. How efficiently is the company collecting their receivables? What's the average collection period? How much inventory do they have to keep on hand in order to generate sales? And again, it's a measure of how wisely management is managing the company. The marketability or the breadth of the product line is an interesting thing. This is more strategic. This is more of a risk area. Is the company overly reliant on one or two or three, a limited number of products? Because if they are, if there's competition or if there's some sort of product problem with one product, it could really cause issues for the company and their ability to pay back. All right, then the coverage of earnings. We're going to take a closer look at coverage of earnings and cash flow over interest and principal. It's the margin of safety. What is the level of cash flow compared to the amount of debt? Okay, so that's something we're going to look at. And then, of course, we'll look at liquidity. And so we'll look at some liquidity ratios, and that is how much cash and marketable securities does the company have on their balance sheet to cover interest and principal payments, liquidity. All right, we'll look at the stability of cash flow and earnings and the stability of profitability. The more stable a company is in terms of their profits and cash flow, the more debt the company can afford to take on. The comfort level that the company can pay their debt rises. All right. Then there's financial leverage. That's looking at the capital structure. It's ratios like debt to equity or debt as a percentage of total capital. Okay? And this is something that's interesting. Contingent liabilities Got to be careful of those. We'll drill down and get some details on that. Contingent liabilities that could result in claims against the company in the future. All right, so let's take a little closer look at some of the ratios, the more important ratios that a credit analyst is going to look at. And you start with coverage ratios, the coverage ratios. And this measures the adequacy of earnings. Okay. Why'd it go that way? See if we can get it to go. Man, this is not the smoothest operation, is it? Okay, here we go. Okay, so coverage refers to the margin of safety that creditors have based on the comparison of a customer's earnings or cash flow with expenses. Okay, so the best known coverage ratios include interest coverage, otherwise known as times interest earned. So the interest coverage ratio is operating income, or EBIT, from the income statement divided by interest expense. So how does operating income compare with interest expense? A better known, more commonly used coverage ratio is debt service coverage. You see this ratio a lot in banking, you see it a lot in real estate, debt service coverage. So debt service coverage is the ratio of operating income in the numerator and interest and principal in the denominator. Now, note that principal is what we call grossed up, because principal is not deductible. It actually is more costly than interest. So you take the principal, divide it by 1 minus the tax rate, and then you add it to interest, and that is your denominator. So we're comparing the cash flow that we have available with the cash that has to go out to the bank. And of course, you want this to be very large compared to this as a lender and as a borrower. All right, then there is the ratio of EBITDA to debt service, so that's operating income plus depreciation and amortization. And I think that's probably better than the debt service coverage, EBITDA to debt service. This is debt service. Okay, that's the payment. All right, the ratio of EBITDA from the income statement to total liabilities is a ratio that a lot of analysts like to look at. And again, the higher this is compared to this, the more comfortable you are with debt. Okay, then there's fixed obligation coverage. And fixed obligation coverage is operating income divided by interest, principal, lease payments, and taxes. Okay, so lease payments on equipment and on office space, things like that, that don't show up on the balance sheet as liabilities, but you know you've got to pay them. So again, you're comparing how much cash flow you have available with the payments that you have to make. Trying to get a handle on, can the company afford to take on debt? All right, then the best known cash flow indicator is free cash flow. And free cash flow, we take cash flow from operations, which is net income plus depreciation, and then subtract out the investment, the incremental investment that companies have to make in short and long-term assets. So this is primarily accounts receivable and inventory and property, plant, and equipment. So this is money that's got to be spent. This is money that's generated. This is money that's spent, and also dividends come out of there. Okay, so this is free cash flow. How many dollars? This is not a ratio. This is a dollar figure. All right, and then often people will compare free cash flow to liabilities or free cash flow to debt service to see what the coverage looks like. All right, this is right out of ManFin. All right, then some of the liquidity ratios that analysts like to look at. And why do we look at liquidity? How much cash do you already have available? Cash and marketable securities do you already have available? So this is not cash flow. This is cash and marketable securities already on the balance sheet. And we'll compare that to loan payments. And so we have the current ratio, current assets divided by current liabilities, and you know the current assets primarily, we're looking at cash, marketable securities, and inventory, and divide that by the payments that we have coming due, okay? Asset test ratio, we're going to take inventory out of our current assets to see how much we have available to pay our current liabilities. And then net liquid assets, which is current assets. So this is a dollar number. This is a percentage, and this is a dollar number. Current assets minus inventory minus current liabilities. How much money do we have left over? It's a dollar figure, okay? Net working capital, current assets minus current liabilities. How many? Again, a dollar figure. How many dollars do we have left over after we pay all of our current liabilities? Then the leverage ratios reflects management's attitude about debt and equity. How is the company being financed? What decisions has management made about financing the company? And the two choices obviously are debt and equity. Maybe preferred stock thrown in there sometimes when you have to, okay? All right, so the ratios that we look at, total liabilities to total assets. The higher the liabilities are compared to assets, the higher the leverage is, the higher the debt is. Long-term debt divided by liabilities plus equity. That's debt as a percentage of total capital. That's what that ratio is. Liabilities divided by sales. That's not a ratio that I've ever really looked at. Not really familiar with that. So again, we're trying to get a feel for how much debt does the company have on its balance sheet, and how much how much flexibility do you have? The higher these ratios are, the less flexibility a company has to borrow additional money. The higher these ratios are, the scarier it is for companies in terms of their ability to pay. All right, profit numbers that we look at are really important. Profit tells us a lot about a company's capacity to repay a loan. So the first thing we look at is dollar gross profit. How much gross profit, how many gross profit dollars does the company generate? And then we compare gross profit dollars to sales, and we get the gross profit margin percentage. And that's a number that allows us to make some comparisons with history, comparisons with peers. Okay. Then there's the dollar amount of operating profit, or EBIT, and then we have operating profit margin percentage, which is EBIT, or operating profit dollars divided by sales. Okay. Then there's the dollar net income and the dollar profit margin, net profit margin percentage, and that's the bottom line. How are we doing managing our company at the end of the day? How much do we put in our pocket? All right, and then there's return indicators, and we're comparing net income with assets and with equity. So profitability is a nice number to have, a nice number to know, but it's not a complete picture. The complete picture is net income compared with assets and with equity. Okay? How much do we have to invest in order to generate our net income? That's what this ratio tells us. Okay? And so it's a percentage return. Return on assets, as you know, net income divided by average total assets, and return on equity, net income divided by average owner's equity. These are all very standard ratios. All right, peer analysis. There's several services out there that enable people to compare the numbers, all the ratios for one company with other companies and with industry benchmarks. So there's Dun & Bradstreet, S&P, Merchant Online, Factiva, OneSource, Yahoo Industry. These are all sources, and there are many more sources that enable you to compare the ratios of an individual company with competitors and with an industry. And it gives you a great sense of how your company stands, how your company is doing compared to the industry. And that's very important to know. All right, contingent liabilities, as I mentioned earlier, These are items that are not on the balance sheet, okay, but they could be potentially significant claims against the borrower. So before you loan money, it's a good thing to tick off your list of questions. Okay, so what are typical sources of contingent liabilities? Well, warranties. If you have a product that goes bad and you have to replace the product, or you have to provide service that's very costly, that could really knock your profit margin and your cash flow down. If there are any pending lawsuits or possible lawsuits that are brewing out there against the firm, that's important to know. Unfunded pension liabilities, which means that you have a pension plan and you promised to make payments to retirees and you haven't put enough money aside to meet those liabilities, that could really cost you. Okay. Any taxes out there? I personally have seen some companies that have gotten in trouble by not paying their taxes, so that's an important question to ask. Okay. And then any regulations that are really important to a firm that could hurt your profitability or maybe even shut you down. So you need to be aware of those kinds of things, these what we call contingent liabilities. So again, these are just items on a list that before you commit the bank to making a loan, you need to make sure that you ask these questions. All right, the next issue that we'll look at is what's called pricing a loan, setting the interest rate on a loan, often referred to as loan pricing. And so, as you heard Jamie and Reese mention, when you're a community bank, you typically have a lot of latitude when it comes to pricing a loan. You know the borrower that you're talking to, you know their business, you understand their situation, you know where they live, and often you'll make an exception or set a price or a rate that's unique to that situation. The larger the bank, the fewer exceptions that they make when it comes to pricing a loan and loan terms. All right, so what's your goal when you're setting a rate? Charge a high enough rate to ensure that each loan will be profitable, but profit is not enough. It also has to compensate for the risk that you're taking when you make the loan. And you know the relationship between risk and return. The higher the risk, the higher the rate has got to be. Okay? And so there are two approaches to pricing a loan. One is called the cost plus, or the build-up pricing model. Okay? And so the loan interest rate is equal to, we start with the percentage cost of loanable funds. Okay? What's your deposit cost? What's your cost on bonds? Okay? So you start with your cost of funds. To that, you add your operating costs. So you go to your income statement and you divide your operating costs, your non-interest costs, your operating costs into revenue. This is on the income statement. And so you got to cover the cost of funds, plus you have to cover the cost of operations. Okay? Plus you have to look at the provision of loan losses, the loan loss provision on the income statement. Okay? And compare that to the loans on the balance sheet. That's typically somewhere in the 1% to 2% range. Okay? So you've got, let's say you're paying 1% on checking accounts and savings accounts, and you're paying 1% on operating costs, and you're paying 1% on loan losses. Okay? And then you got a target profit margin percentage, and that might be 3%. So you got 1%, 2%, 3%, plus another 3%. 6% is going to be your loan cost. All right, that's going to be your target loan cost. So this is the build-up, the cost plus, or the build-up method. Okay. Now the other approach is called the prime rate plus model. The prime rate plus model. It's a little bit easier to do, okay? And so the loan interest rate, you start with the prime rate, or LIBOR, and we'll talk about both on the next slide. And you add a default risk premium, okay? What's the chance What's the risk that the borrower is not going to pay you back? And then you also add a premium for the time. Okay, the longer the loan is going to be outstanding, the higher the term premium is going to be. So you start with prime rate, and you add a premium for risk and a premium for time, and you come up with your interest rate or pricing. All right, so let's look at the prime rate. All right, so the prime rate is the rate for a short-term loan made to a bank's most credit-worthy borrowers. So the best borrowers that come into the bank, what rate would you give them? Okay? And each U.S. bank actually sets its own prime rate. Right? Then the Wall Street Journal will survey 30 banks to see what their prime rate is, and they will publish the average number. And that's a lot of other banks will look at this average number and then add a premium to that number depending on what kind of borrower they're dealing with. All right. So when these 30 banks are setting their prime rate, they'll start with the Fed funds rate as the base, and then they'll add a premium to cover default risk, time, and profit margins. So that's how the prime rate is set. So you've got people at the bank that are studying these factors, and they set the prime rate, and it's going to change on almost a daily basis. Okay? And studies show that the typical spread over Fed funds has been about 3 percentage points. So you take the Fed funds and you add 3 points in order to cover default and time and profit margin. All right? So the Fed funds rate right now is, I think, 2 1/4, somewhere between 2 1/4 and 2 1/2. And so the prime rate on a business loan is going to be about 5 1/4 to 5.5%. And a couple of years ago, before the Fed started raising rates, the Fed funds rate was 0. And so you were looking at a bank loan rate of about 3%. All right, what is LIBOR? LIBOR, it's an acronym, and it stands for London Interbank Offered Rate. And what it is it is the international version of the Fed funds rate. And you know what Fed funds is? That's when banks loan to each other. So it's the base rate that global banks charge for loans that they make to each other. Why do they make these loans? Largely for liquidity purposes, to make sure that banks have enough cash on hand to meet their regulations. Okay? So again, you take 8 to 16 banks, it depends on how many are available that day, to meet the survey. And so these banks are surveyed, and they will disclose what rate they are charging to make overnight loans. Okay? Actually, it's more than overnight. So LIBOR is quoted from 10 different currencies, and for 7 maturities, different lengths of time, ranging from 1 day to 1 year. So when you say LIBOR, unlike the prime rate, the LIBOR rate is for different maturities, and that gives you an idea. If you're a bank and you're looking at different term loans, then you can look at LIBOR to see what the going rate is for these different types of loans, and you can decide where you want to be in terms of your price compared to other banks. How aggressive do you want to be? All right, lastly, there's the customer profitability analysis. This is another way of looking at how to price a loan. All right. So with this, when you're looking at pricing a loan, you take into consideration everything that you're doing with the customer. Okay. So you may be doing trust, you may be doing wealth management, you may be selling insurance to the customer, and that is going to impact, there may be a compensating balance, that is going to impact the rate you charge the customer. The more business you're doing with a customer, the lower the rate will probably be. Okay? So what we do to measure the profitability of a customer, so we take the rate of return to the lender from the whole customer relationship, and that is equal to revenues from loans and from other services provided to this customer. So you're going to have to look and see what all the customer is doing with you, and subtract from that expenses from providing loans and services to this customer. So we'll get into the details of what that means, and then you divide that into the amount of funds used in excess of the customer's compensating balance. All right? So we're going to take a detailed look at how this works. Okay? So what are sources of revenue from the borrower? Well, interest income that you charge on the loan, fees from loan commitments like on a revolving line of credit, fees on trust, insurance, wealth management, so you throw those fees in there as well. Okay? And what are loan-related expenses? Okay, first, interest that you have to pay on the borrower's compensating balance. So if you ask for a compensating balance, you got to pay interest on that balance. Okay? Interest paid on the bank's source of funds. So the bank is going to fund the loan with deposits, bonds, or Fed funds, and they're going to have to pay for that. This will all become clear in an example. And then administrative costs. So you have revenues and you have expenses. So let's look at an example to make this all clear. Okay, here we go. So let's say we've got $1.5 million line of credit with a customer for 6 months. Okay? The term is 9% APR, the rate, 20% compensating balance, 1% loan commitment fee. You're currently paying 3% on deposits, kind of a high rate. The administrative cost of providing these services, $25,000. That seems kind of high. Okay. Then you're also, the customer is also doing trust business with you, so you're charging them $60,000 for that. So let's look at the revenues. Okay, so the revenues are, you take the $1.5 million line of credit, times 9% divided by 2 because it's only for half a year, and you're going to get interest of $67,500. Okay? The trust service fee is $60,000. The loan commitment fee is $1.5 million times 1%, so you're going to get another $15,000 from the customer. Okay? Your total revenue from this customer is going to be $142,500. Okay? The expenses are the administrative cost of $25,000, then the interest on the compensating balance, and the loanable funds. So the compensating balance, let's see, we said was 20%, and so you're loaning $1.5 million plus a 20% compensating balance. So 20% of $1.5 million is $300,000. So you add the $300,000 to the $1.5 million, and you got a total of $1.8 million. And it's going to cost you 3%. You have to pay 3% on that $1.8 million. So you're going to pay interest expense of $27,000. Okay? So your total expenses are going to be your administrative cost of $25,000 plus your interest cost of $27,000, $52,000. Okay? So your return is your total revenues minus your expenses, or your profit actually, total revenue minus expenses, $90,500, and then we're going to go ahead and divide that into the $1.5 million that you're going to loan, and what you get is a 6% rate of return on the client, and since that's a half-year number, we're going to multiply that by 2, and this is a 12% client for you. So as you try to assess how valuable this customer is to you, this is what you're looking at, 12%, and that gives you an idea. And if that's the going rate for you, if you're dealing with a customer that is not doing trust with you, okay, not doing wealth management with you, then 9% is probably too low for that other customer. If your target is to earn 12% on a customer, and the customer is not doing trust or wealth management or insurance, you're probably going to have to increase the loan rate. Okay? And again, your goal is to earn a rate of return that covers your costs and also covers the risk of the loan. All right, so that's chapter 17. We're going to shift over. I'm going to stop the camera right now, and I'll start another clip for chapter 18.